Everyone is sick of information right now. There's just too much information, too many headlines, too many files, too much news and data, and this person's hot take, which just so happens to be completely in conflict with everything you've ever understood about money and real estate. And of course, this week, we got even more data and headlines. And of course, all of it should impact your real estate strategy. But I wouldn't blame you at this point if you were just tired of trying to keep up. So why am I still going to show up here on Friday with this blog? Besides the fact that I want to help you sound smart at happy hour, I want to help you find clarity. That's what we really need. Not more information, not even my advice. You don't need that. You need clarity so that you can feel confident that you're making the best decision you can with the information available now. So, of course, each letter stands for something in my clarity framework. C is for context. Here's what happened this week. We got weak sales numbers, then we got strong jobs numbers, and then just this morning, a couple hours ago, we got good news on inflation numbers. The truth is, it's okay to find yourself at this point thinking, I don't give a shit about any of it, Shivani. I'm here to give you the context of why it matters that markets are trying to break through conflicting truths and figure out what's really happening in the economy. I'm here to give you the context of why that matters to you. Markets do not trade based on data alone. They move based on expectations. This week, the market felt good that the data would allow the Fed to be more comfortable easing their policies, which ultimately leads to lower interest rates. Overall, and in spite of a strong jobs report midweek, mortgage rates are currently improving based on that expectation. L is for the latest data, and the fact that the psychology around this data matters more than the data itself. We've been talking about this for weeks, so I won't beat a dead horse on the psychology. But today's CPI numbers show inflation moving closer to the Fed's target. Housing costs were a big part of this cooling, so were gas prices. Inflation is now at a 5-year low, and that's a very big deal in terms of predicting what Fed policy will look like in the coming months. Rate cuts. A is for analyze. We have to do some analysis, but not to the point of paralysis. Let's talk about market reactions this week. On Tuesday, mortgage bonds rallied after the data came out signaling a weaker economy. This was when we got that weak retail sales number. But the jobs report came out way stronger than the market expected, and that was the whole counter narrative. Bonds didn't completely flip out, but they did give back some of their gains on Wednesday. Then Thursday, it was like the market had a chance to digest the information and decide, hey, this jobs report has been kind of full of drama for the last couple years and unreliable, and maybe it's fake news. We saw a rally in mortgage bonds based on no new information. This proves that building a strategy around timing interest rates will give you digestive problems. It also tells us that investors themselves are sick of the jobs report. They don't buy it anymore, and they're just paying more attention to growth signals, like the retail sales numbers we got and the inflation numbers we got today. R is for risk and reward. I want my clients to understand this about interest rates. Every time there is a rally, so far this year, the market just bats it back down. So my advice is to find a payment range you are comfortable with instead of an interest rate that you're targeting. For example, rather than saying that you're waiting to buy until interest rates come down, look at it like this. I can afford a payment between $2,800 and $3,200. So I need to shop for houses that give me a payment in that range based on interest rates in a 0.5 point variance. I want to make sure, let me make sure that you are following me. Make sure that even if rates went up 0.5 point, you're still in your payment range for that price point. Then you only have to reevaluate your whole plan, meaning adjust the price range you're shopping in if rates move more than 0.5 point. I will go ahead and say this right now, even though I shouldn't. The risk with real estate in 2026 isn't that you'll buy and then rates will come down after you bought. It's not even that you'll buy at the height of home prices for this cycle. That is all bullshit. It's bullshit that buyers tell themselves when they aren't ready for a variety of other completely different reasons. The risk right now, the only real risk, is that you will stress yourself out so much trying to keep up with the market and the headlines and trying to time the market, which is trying to catch a falling knife, and you will become emotionally fatigued by all of it, and then you will just give up. I is for interpret. That's why I always bring this back to what it means for you specifically. Based on this week's news, we are likely heading into the spring buying season with optimism from buyers and sellers alike that interest rates are trending down. Consider everything I've taught you about what happens to supply and demand, what happens to home prices when interest rates are trending down. Interpret and decide whether you want to be ahead of that or behind it. T is for translate. So you can translate whatever the new information is into actions you're going to take. Action is to sit this cycle out. That's a choice. That's an action. Action in terms of looking more aggressively for a home that fits your needs. For my realtors, action is changing your messaging, your outreach, the advice you're giving your clients. The best way out of analysis paralysis, and this applies way beyond real estate and housing and what we talk about here every Friday. The best way out of analysis paralysis is to start taking action, even if it's small actions. Y is for your plan. And I know I'm cheating here a little bit to make Y connect to plan, but your plan. I really want you to have a plan because waiting is not a plan. When I talk to people about waiting, I often find that they don't even really know what exactly it is they're waiting for. They're just nervous, they're overwhelmed, or they have misinformation, which is why I wanted to focus on clarity this week. We got a ton of information this week that you, or maybe your clients, don't have a plan in place for. So the information just adds to the chaos. When you have a plan you can consider, then you can quickly decide how the latest information should influence your plan, if at all.